Hello, I'm Todd Rosen. I'm a wealth management advisor with Mayborn and Clark, and I thought after today's ugly day in the market, this would be a good day to share a piece like this. It's from First Trust. I use it with clients. It's called Markets in Perspective, and I think it's just a really good reminder to kind of zoom out and look at the big picture. Days like today are uncomfortable, but you can see here on this slide, there's a number of negative headlines that created volatility in the markets. But the reality is, if you were to have invested $10,000 back in 1970, it'd be worth almost $3 million by the end of 2024. So it's a really good reminder. This is normal. Markets, they go up, they go down, but in the long run, it's up and to the right. Another good piece here is we were a little bit spoiled last year. The drawdowns throughout the year, we had a negative 10% in 2023, negative 8% in 2024. Yet the market still ended up 24 and 23% respectively. 2020, even more volatility. I'm hoping we don't get that this year, but it was down 34% at one point, and it still finished the year positive 16%. So it's one of those things where, the gut reaction a lot of times is to just jump out, go to cash. But the reality is it's hard to time that. And there's some pieces in the slide talking about, the difficulty of getting back in. A lot of times these are news-driven events, and we just as easily could get a catalyst to the upside, overnight or tomorrow. This is a good slide. Again, only going back to 2007, but it shows average return for stocks or stock indexes in that time would have been 10% on the S&P 500. Treasuries 2.5%. So a lot of times people will have somewhat of a balance between stocks and bonds or treasuries. But the reason they do that is to kind of smooth out these curves. Not everyone wants to deal with these big drawdowns. So by combining different asset classes together, it tends to kind of smooth out that curve and make it a little easier to tolerate some of these ups and downs so you're not fully exposed to the market when we have days like we had today. This is another good reminder too. This is going back to the 40s. Shows the various bull and bear markets that we've had. One of the better takeaways is the average bull market lasted 4 years. The average bear market lasted 11 months. And the return in that 4-year period, 4.3 years, was 150%. And in the bear markets, it's down 32% almost. So you never know. I'm hoping we're starting the next good bull run here. But part of that is staying the course and just being patient and not reacting to news and volatility events like we had today. For people that have a tendency to go to cash after a day like today, you can see here, if you were staying in the market the entire time from 1979 through 2024, that's what you would have had from $10,000 original investment. But when you do go to cash and you miss some of those best days when you get that snap back in the market, missing the 5 best days, you have $1 million. You miss the 10 best, 762. So it makes a big difference in the long run, and it is ultimately best to just stay the course and ride out all the ups and downs and not worry about it. Easier said than done, but you can clearly see here that you don't want to be jumping in and out of the market. Similar here, going back almost 100 years. Of those 99 years, 73 were positive, 26 were negative. Average returns in the positive years were far greater than the negative years. So again, long-term average over 10% in this case on the S&P 500. The other thing to keep in mind is your time horizon. So if you need this money in 3 months, there's a 30% chance you will have lost money. Whereas if you need the money in 3 years, 5 years, or longer, the longer you have, the higher probability of a positive outcome. So again, the longer you can stay invested, the more likely you will have been to have made money. More about volatility. So a number of days with greater than 1% moves. Today certainly was one of those days. Last year, fortunately, we only had 50 of those days, but there are periods of increased volatility. 2020, 2022 were rough years to be in the markets, and we had a number of days with greater than 1% moves. The other thing, looking back historically, we've had a number of terrible days in the market. You can see here, these were tough to sit through. Today, I think it was down. S&P might have been down a couple percent, but kind of pales in comparison to what these days show. But the big takeaway here is 1 and 3 years later, you had a high probability of returns and a solid return at that. So 1 year out on average, 30%. Certainly some outliers out there, some negative ones, up 45%, up 66%. COVID, up 59% 1 year later. So you never know. Again, staying in the market for the long run. And this is normal. This is the last slide, but it's normal. 5% drawdowns happen 3 times a year on average with S&P 500. A 10% drawdown is once every 16 months. So not that frequent, but they do happen. So that's all part of investing. I assume a lot of you have had investments in 401ks for a long time, so it's nothing new. But again, these are good reminders. And I think one of the big takeaways too is you want to make sure you have the proper risk tolerance and for your investments. So these examples were all with 100% exposure to the S&P 500, but most people can't handle that kind of whipsaw action, and most people, based on the risk tolerance, will have some kind of balance between low risk investments and higher risk investments to kind of smooth out that curve. So anyone looking for a risk assessment, feel free to message me. I'm happy to send a link to one of our risk profile questionnaires, which will factor some behavioral questions alongside some time horizon questions and help to see what a better fit would be for you. So again, thank you for watching. Appreciate it.